A USDA loan could help you buy a home with zero money down, but do you qualify? In this video, I'll explain how the USDA loan works, who qualifies, what's new for 2025, and some key things to know about before applying. A USDA loan is a government-backed mortgage that allows eligible home buyers to purchase a home in designated rural and suburban areas with 0% down. To qualify, buyers must meet income limits, which vary by location and household size. This loan makes homeownership accessible for more people. There are two different types of USDA loans. The first one is the Direct Loan Program. It's aimed at low and very low income households. I'll talk about income and how that works in a moment. This is a loan that's managed directly by USDA Rural Development. You can get interest rates as low as 1%. As of this recording, the interest rate starts at around 5%. If you were to go to any old lender, a regular interest rate would start at around 6.5% to 7% right now. To give you an idea of how good these interest rates are, the USDA Direct Loan interest rate is updated monthly. So by the time you're watching this video, the interest rate could be different. There are longer repayment terms, 33 to 38 years. A typical home loan is 30 years. It'll depend on your income on how many years you're given to repay the loan. Having 33 to 38 years to repay the loan is helpful because you get a little bit longer to repay the loan and your monthly payment will be lower. There are stricter income limits with the USDA Direct Loan. I have some resource links in the description, and one of them is on income limits. You can also go to my website at workwithdang.com for more resources, and I can help you find a real estate agent in your area. To qualify for Direct, you're going to look at where it says low or very low. This is designed for borrowers who are going to have difficulty qualifying for other loans. Then there's the Guaranteed Loan Program. This is aimed at moderate income households, meaning they make 115% or less of the median income in the area. The loan is issued by approved lenders but backed by the USDA. What that means is that if you were to go to your bank, credit union, or any other place that you can get a home loan, you might be able to get a loan through them if they're a USDA qualified and approved lender. The loan is backed by the USDA, meaning that if for whatever reason you default on the loan, that's when the USDA comes in and helps pay the debt. It's kind of like an insurance policy for the lender. For the USDA Direct Loan, you apply through Rural Development. I'll talk about how to apply for both loans later in the video. The USDA Guaranteed Loan is a 30-year fixed rate term. So that means that the loan will be at the same interest rate for the full 30-year length of the loan unless you refinance. The lender sets the interest rates, which will be closer to the interest rate you can get in the open market. So you probably wouldn't be getting a 4 or 5% interest rate or anything like that. The household income limits vary by location and by household size. Everyone's income in the household will count if they're going to live in the home. Here's the breakdown. If your parents are going to live in the house, or if you're applying for the loan, but not your spouse, partner, whatever, their income will count for this income eligibility threshold. So if you have a parent who's going to live with you and they get Social Security income, that counts. If you have an adult child who's not a full-time student, that would also count towards your income. Income for minors living in the household does not count for income eligibility. Basically, everyone's income who's 18 or older will count toward income eligibility, regardless if they will be on the loan or not. If you're concerned that you might be a little bit over the income limit, there's some good news here. Some adjustments can be made to your income. When you go to your lender, they'll look through everything to see what deductions you might qualify for. Some of them include a $480 deduction per child that's under 18. If you have an adult full-time student who lives with you, they would also get a deduction, assuming they don't work. If they do work, the first $480 of their income counts toward income eligibility, but you'll get a $480 deduction since they're a full-time student, which is defined as 12 credit hours. So for a full-time student that works, they'll count for $0 as far as income eligibility goes. Now, just to be clear, if one of the applicants is a full-time student, their income will count in full. There's also a medical expenses deduction for seniors, which is someone 62 years or older, or for disabled household members. They're eligible to deduct unreimbursed medical expenses. Childcare expenses can be deducted if they allow you to work or go to school. Childcare expenses only count for children 12 and under. Seniors living in the home counts toward a $400 deduction. You only get this deduction once. So if you have one senior or two seniors living in the house, regardless, you get a total of a $400 deduction. Let's talk about repayment income. As an example, let's say you have a couple that's living together and also a parent. Only the couple is applying for the loan. After the deductions are made, the lender will figure out what your repayment income is. The repayment income focuses only on the applicants listed on the loan. If the couple is applying for the loan, The repayment income will only be based on the couple, not on the parent that lives with them. There's not a strict minimum credit score that the USDA requires. However, a 640 or more score qualifies you for automatic underwriting. Something you should know is that for guaranteed loans, which is the loan you would get from any old lender, there's something called an overlay. An overlay is a requirement that the lender also puts on the loan. I've heard of people getting a USDA loan that have credit scores somewhere in the 500 range, but a particular lender could say, well, we only qualify applicants at 640 or 680. That's why it's important anytime that you're looking for a lender, but especially with the USDA loan, you want to go to a few different lenders because everyone's going to have different requirements. A quick note here, when the lenders are looking at your credit score for a home loan, they're going to use your FICO score, which might be different from the score that you see on sites like Credit Karma. There are also alternative credit options. Let's say you either don't have a credit score or maybe your credit score isn't the best. Sometimes other credit options could be used. For instance, rent payments and utilities count. A new thing for 2025 is subscription services like the gym or Netflix counts. This can help you prove that you have a history of making payments, and that's what the USDA wants to see. They want to make sure that you can repay this loan. The debt-to-income ratio plays another big part of the USDA loan and is a little limiting compared to other loans. The debt-to-income ratio, or DTI, is a percentage that compares your monthly debt payments to your gross monthly income, which is your income before taxes. Lenders use DTI to determine how much house you can afford and whether you qualify for a home loan. For the housing expense portion, also called the front-end DTI, they want your debt-to-income ratio to be no more than 34% of your gross monthly income. This is another new thing for 2025, and specifically for the guaranteed loan. It used to be 29%, but then you could get it extended to 31%. Now it's just 34% of the housing expense. This is for the guaranteed loan. The direct loan has a front-end DTI of 33%. The front-end debt-to-income ratio is your PITI. P is for the principal of the loan, the amount that you're borrowing. Then I is for interest, and T is for property taxes. Then the other I is for insurance. This will include your home insurance and also the guarantee fee that I'll talk about a little bit later. You also include the HOA fee if you're in a homeowners association. What doesn't count is water, electricity, and the internet, things like that. Those bills don't count toward your front-end DTI. Then there's your total DTI, or the back end. This will include debts like a car payment, student loans, and minimum monthly payments on credit cards. Things like that. Medical bills don't count toward your DTI. The maximum is 41% for the guaranteed loan, but there are some exceptions where you can go up to 44% with some compensating factors. First, all applicants will need a credit score of 680 or higher, then have at least one of these compensating factors, which is savings or cash reserves. You would need 3 months worth of PITI, which again is the principal, interest, taxes, and insurance in reserves after closing. Some acceptable forms of reserves can include money in a checking or savings account, funds in money market accounts, or other liquid, readily accessible funds. Retirement accounts like an IRA or 401k also count. Cash doesn't count, so if you have cash in a safe or under the bed or whatever you got going on, that doesn't work. Retirement accounts can count toward reserves, but only the readily accessible portion qualifies. Another thing that makes this loan a little bit interesting and different from others is that there are some location requirements. What that means is that the home must be in a USDA designated area. In the resource links in the description, you'll find a USDA eligibility map where you can look at the map or enter a specific address to see if it qualifies for USDA financing. You might be surprised at what locations qualify for the USDA loan program. Some homes are just 30 minutes away from a major city, so you're not necessarily in the middle of nowhere. Many suburban areas also qualify. USDA loans generally require applicants to have at least 12 months of stable and dependable employment before applying. For W-2 employees, a 2-year work history is preferred, but gaps of less than 6 months may be acceptable with a strong employment record. Education is no longer accepted as a part of the 2-year work history. Self-employed applicants must have 2 years of tax returns to verify stable income. Now let's talk about the types of properties that you can get with the USDA loan. It includes single-family homes, modular homes, condos, and a duplex if you're buying one side. Townhomes could be eligible, as well as certain manufactured homes if they're less than a year old. Something good to know here is that although I mentioned that condos, townhomes, and duplexes qualify, in more rural areas areas, you may not find those properties as often. Also, I haven't personally seen a lot of those close with USDA loans, but it's just one of the properties that they say that you can get a loan with. If you're focused on a condo or a townhome with the USDA loan, there may not be many options available. Homes must meet all other USDA requirements, including a permanent foundation, and meet the HUD standards, which FHA and VA loans also follow. Ineligible properties for this loan are multifamily units, unless it's a duplex and you're only buying one side, investment properties, and homes with income-producing features. This loan is for people who are looking for a primary residence, and it's intended to help those who might have difficulty finding a home otherwise. This isn't the loan for someone looking to buy an Airbnb, house hack, or invest in rental properties. A home with an accessory dwelling unit or ADU might qualify. There have been some recent changes for 2025. Accessory dwelling units might be okay as long as they're not income producing. Ultimately, the appraiser is the one who provides information to the USDA to establish if the home is income producing or not. One of the key terms used when researching USDA eligible properties is modest. Homes must be considered modest in size, design, and cost relative to other homes in the area. This means that the home should be similar to others in the neighborhood. There isn't a specific square footage limit for homes, but properties that are excessively large or luxurious, like a mansion or an estate, wouldn't qualify. The most up-to-date information on USDA home size guidelines can be found in the latest USDA handbook on the USDA website. You might see some conflicting information about this online, so always check with the official USDA handbook for accuracy. There's a minimum size requirement for mobile homes, which is 400 square feet. However, tiny homes under 400 square feet that are built on a slab and are stick-built could qualify. Let me clarify though, just because a tiny home could meet the USDA requirements, in reality, most lenders may not finance them. Tiny homes are a niche product, and lenders may consider them too risky as an investment. So just because a tiny home could meet USDA guidelines, that doesn't necessarily mean it will get approved for financing. The home has to be a functional living space. That means that the home must be designed for single-family residential use and have functional living space, including necessary rooms like bedrooms, bathrooms, a kitchen, and a living room. The home has to be reasonable. The USDA assesses whether the home size and features are reasonable for the applicant's household size and financial circumstances. When you hear the term HUD standards, that means the home must meet health and safety guidelines, like functional plumbing, heating, and no lead-based paint. The home doesn't have to be a certain age, it just has to meet the HUD standards. Now let's talk about the cost of loans a little bit. Again, this is a no down payment loan. It's 100% financing. However, there are some costs to this loan. There are closing costs, which are typically between 2 and 6% of the purchase price, and this doesn't include a buyer broker fee. There are some different options to cover closing costs. These include seller concessions up to 6%. You can roll the closing costs into the loan if the home appraises above the purchase price, or you can use gift funds. Just a note here, although this is a 0% down loan and you can get closing costs paid for, there are a few items that you may need money up front for, like an escrow deposit, inspection fee, and appraisal. If you're getting the direct loan, there's also a fee for a credit check and a homebuyer course that you can potentially get reimbursed for when the loan closes. I mentioned earlier about the guarantee fee. For guaranteed loans, there's a 1% upfront guarantee fee that can be rolled into the loan. This means that you essentially get a 101% financing because you finance 100% of the property, but also that 1% upfront guarantee fee. There's also an annual guarantee fee, which is paid monthly. This is kind of the equivalent of mortgage insurance for the guaranteed loan. For the direct loan, there's no guarantee fee or annual fee. Let's talk about some of the things to keep in mind with the USDA loan. First is that equity growth will be slower because of the zero down payment. What this means is that equity is the amount of money that the home is worth beyond what you still owe. If you buy a home with the USDA loan, and let's say you're in a place where homes aren't appreciating rapidly like they were a few years ago, and then you have to sell the home within a year or two, you're not going to have a lot of equity in the home. After you pay all the different closing costs as a seller, there probably won't be a lot of money left for your next move. So just know that the USDA loan is a great product, but it is going to take longer to build a lot of equity in the home. Another potential issue is funding can run out on the USDA loan. This is more of an issue with the direct loan over the guaranteed, Basically, what happens is you can be put on a wait list until more funds are issued. If there's a government shutdown or something like that, that can delay the loan closing process. Also, in a hot market, it can be hard to get a home under contract with the USDA loan. Since the USDA loan requires certain property conditions, some sellers may prefer to go with a cash buyer or someone buying with a conventional loan. Small issues like chip paint could make it where the appraiser will require repairs. Because of things like that, sometimes sellers would prefer to go with a buyer that has more lenient loan requirements. If you're getting the USDA direct loan, the closing could be up to 90 days. Some sellers may not want to wait that long. For the guaranteed loan, it should be about 30 days. With the direct loan, you apply directly through USDA Rural Development. You can go online to determine if you're eligible on the USDA website. Then what you'll do is call your local office and you'll start talking to a USDA Rural Development representative who can help you get an application and all that kind of stuff. You can also just go down to your local office if it's close. Now, the process can take a long time for the USDA direct loan. I've heard of some people taking about 4 months from application to close, while others wait for over 2 years and still haven't closed on a home or even got their certificate of eligibility, which is the USDA direct loans version of a pre-approval letter. If you're someone who can qualify for both a guaranteed and a direct loan, the reason you might choose the direct loan is because the interest rate is so much lower compared to what you'll find at a regular lender. You might have to wait a while and be patient. It can take many months to get your certificate of eligibility. As I mentioned before, the program can run out of funds. Now, with the guaranteed loan, you'll work with an approved USDA lender. So basically, you would just find a USDA-approved lender and give them a call. I have a link in the resource links in the description where you can find a list of USDA-approved lenders. If you're going with the guaranteed loan, it's important to shop around for a few different lenders to see who can get you the best rate and terms. Please like, comment, and subscribe if you've gotten any value from this video. It helps me out a lot.